welcome to another great video. We get lots of great questions and comments, and we like to respond to some of those. And some of them create new videos like this one right here. We had a comment, when does it make the most sense to do the RRSP Meltdown? And we're going to cover that today. Before we got to explain, though, what is the RRSP Meltdown?
Yeah, I mean, the RRSP Meltdown, basically what you're trying to do is take money out of your RRSP faster, because there's a variety of reasons why you want to do this. You don't want to die with a lot of money in your RRSP, period. That is bad, because the government's going to take a whole bunch of it. And again, it can go tax-free to your spouse, but everybody else, that's fully taxable. So slowly melting down the RRSP is a big idea to try and drain that thing. And there's a variety of different options for why you want to do this, how you can do this, maintaining tax brackets and everything else that we can get into. But getting that meltdown is basically taking it from a large portion to a smaller portion so you can save taxes in the long run for your estate and anything else.
Yeah, and the idea there, again, RRSP, big tax liability. Because anyone other than your spouse, there's probably going to be a big tax burden there. And so the idea, if you can chip away at it bit by bit, it'll be a lower tax bracket, save you money in the long run. That's the RRSP Meltdown. We've got a whole video on that strategy.
We do.
So we'll link to that. And now today we're talking about when does it make the most sense to do that. The first tip is the size of the accounts. Because remember that RRSP, that's the tax liability. So if you have a big RRSP, well, that's great for your retirement. Also means you really want to consider the meltdown, because the larger the RRSP, the larger the potential tax liability.
That's the biggest factor. So, I mean, basically, if you're going to have a very large RRSP, you're going to have to draw a certain amount out. If you wait until that 71 time frame, that may be huge. So you may want to start doing that earlier if you're sitting there and you can afford to take the money out, depending on what your taxes are or your situation. And it depends on where you want to go. I mean, if you want to take a look at an RRSP, and it could possibly take the money and go to a TFSA or something along those lines if you have room. Otherwise, you're looking non-registered assets and things along those lines. But that's the biggest factors, trying to get rid of that large tax liability, as you've mentioned, and drawing this down in segments based on a variety of different options.
Yeah, so when does RRSP Meltdown make the most sense? The first tip there, the first factor to consider is size of accounts. You mentioned the larger the RRSP, the more you want to consider the meltdown.
That's right.
Also, the more room you have in your TFSA. Because ideally, you take it out of the RRSP RIF, and since you don't need the funds, that's part of the meltdown strategy, it can go into that tax-free account. That's ideal. If you could just move it over to now, you've dealt with the tax liability in the RRSP. You now have completely tax-free funds, growing, investing you can use down the road. Not everyone has that amount of room in the TFSA. So the RRSP or RIF to TFSA is ideal. If you don't have that kind of room, the RRSP to RIF to a non-registered account, still possible, still doable. You just have a few more details you have to work with there.
Yeah, you have to deal with now in the TFSA, of course, there's never any tax liability for it. Now that you've moved it to non-registered, well, depending on what the investments are, they may earn capital gains, distributions of some format. So there will be some, but it's still better than what you're going to get as pure income coming out of that RRSP or RIF. And doing that, you also want to maintain sort of that looking at where your tax bracket scenario is, right? And you want to make sure that, you could take it all out at once, but then you're paying the same amount of tax if you did it that way. So doing it in smaller chunks, depending on your tax situation, will also help out. And there's a variety of different ways that we want to look at that with like pension splitting and things along those lines.
Exactly. So we had a couple of factors to consider. The size of the accounts, both RRSP and your TFSA room would be one factor. The next is the pension splitting. Like ideally the strategy, if you're a couple and you're both over the age of 65, that's the Goldilocks zone right there. The reason why is because if you're a couple, you can do pension splitting. If you're over the age of 65, money that comes out of a RIF is considered pension income, so it can be split. So now you can divide it over two tax brackets, which will help you both keep within a lower zone.
That's right.
And faster deplete that RRSP. Now, if it's not the case, you're under 65 or you're a single retiree, that's perfectly fine. You can still use the RRSP Meltdown strategy. It's just simply the optimal version of the strategy would apply to couples over 65.
Yeah, and you mentioned, you hit it right on the head, the factor that we want to do that over 65, because under 65, you cannot split those RIFs or those RRSPs. It is pure income to you that has to go on. So you mentioned the Goldilocks scenarios there. And again, of course, another factor that might come into this is, where's your income base right now? Are you in a low income? Maybe you're just, collecting a small pension or something and nothing else has gone on at this point in time. That's the perfect time to draw the large amounts out, because you can within certain tax brackets and go along those lines. Or you could also look to delay your CPP or OAS, depending on how close to those age brackets you are when you want to start taking. If you're closer to 65, you don't have to convert to 71. Take it earlier now and then delay those things down the road might help out as well.
Yeah, so we're looking at a couple of factors. Size of the accounts, bigger the RRSP, more likely you want to consider that meltdown. The more TFSA room you have, well, the better, more likely you want to consider the meltdown. The pension splitting, that could definitely be a factor. And then the third factor, you mentioned the income level. Ideally, you're in a low income area. Now, everyone's going to be a little different. Each province is going to have a different tax bracket when it comes to income taxes, because they all have slightly different numbers. If you could be, I'd say 35% or less in terms of the marginal tax rate,
that would be great.
That'd be ideal.
Yep.
Above that, you can do it, but the numbers get a little trickier. But if you're below that number for your marginal tax rate, this starts to make a lot more sense.
It does.
And that's what we meant by the lower income. And then one way to have lower income, you defer your CPP and your OAS. So now you're in a lower tax situation. You can draw down more of that RSP. And then if you're at a higher income, maybe you got a great defined benefit pension plan. You're one of the lucky few that have those pensions.
Still left
or
around.
You're simply still working in your higher income situation. That's not bad. It just means you got to be cautious and run a couple of numbers here to make sure it still makes sense in the higher tax brackets. It's very possible it could still make sense, but the optimal situation here would be you're in a low tax situation. When does it make the most sense? We talked about the size of the accounts, both RSP, TFSA. We talked about pension splitting, ideally a couple over the age of 65. We talked about the income situation. We had our threshold there, call it 35% marginal tax rate or less. And of course, lots of nuances there, which is why folks want to have a plan so they can see how it specifically fits within their situation. They can run a few forecasts to see if it would save them tax by implementing this strategy. Scenario, you're doing the RRSP Meltdown, you have that non-registered account. How do you minimize the tax there to make sure you end up taking more out of the RRSP? Let's tackle that.
Yeah, basically, like as we said, we're not dealing with the TFSA. We're melting it down. It's got to go to a non-registered account. So what we want to do is basically look at 3 tips that we can try and deal with this to try and make it even more tax efficient and better for you going forward. And basically those are, the first one's dealing with asset location, which we'll get into and describe exactly what it is. The second tip will deal with whole life insurance. And our third one will deal with that corporate class investments and how all 3 of these can minimize your taxes while taking that money out of the RRSP.
Yeah, and a quick explanation. So the RRSP Meltdown, you never want to dial lots of money in your
Never,
RRSP. If
never.
you can avoid it, don't do that because it's a big tax burden. You can go tax-free to your spouse. Anybody else, that RRSP is fully taxed upon passing, which can create a big liability, which is why people try to melt it down instead of deferring it and then having this big burden when they pass away. They do it in little bits and pieces as they go. And commonly, you might take it out of the RRSP and then put it in your tax-free account. But if your tax-free account's already full, it's got to go into the non-registered account. And then that non-registered account is also taxable, and that creates the situation we're dealing with today. How do you handle that non-registered account, minimize that tax? We talked about 3 strategies. The first one there, asset location, is one of the ways you can handle it.
Yeah, and what we're dealing with asset location is where do you put your investments? I mean, theoretically, anything that earns pure income, you want to make sure that that's as tax sheltered as could possibly be. So whether that's your TFSA, whether that's your RSP, it doesn't matter if they're paying income out as a distribution, that is all tax sheltered, so you don't want to worry about it. You'd rather put things in there. When you start earning capital gains, return of capital, or even dividends, those are investments that you want to start looking at for probably the non-registered. So when we mention asset location, things that earn income, we want to keep those basically in the RSP and the RIF, the TFSA. Things that are earning a better tax break scenario is what we're going to want to put in the non-registered. And that's exactly how we divide it. Get our non-registered assets in that class and keep our registered assets more on the income-oriented basis.
Yeah, and that's the idea. The idea that maybe you have a mix of investments. Let's say you're a balanced investor, so you've got a couple of pieces in the puzzle. Instead of having every single account being exactly balanced, you could say, all right, of that balanced portfolio, there'll be pieces that are more tax-friendly. Those will be the pieces we put in the non-registered account, which will lower the tax bill there. And the other ones we'll keep in the RSP and the TFSA because they won't really matter. They're all taxed the same from those accounts regardless. And that kind of mixture overall lowers your tax bill, which would be one way to help out. Now, pros and cons of everything. There's always trade-offs. No magic solution, just trade-offs. And for this strategy, you kind of need similar size accounts. If your non-registered account of that bucket is really big and your RSP and TFSA are smaller, well, if you load up on strategies that are tax efficient in the non-registered account, that could mean you end up with a lot of growth stocks, as an example, which could be way too much risk and could put your plan offside. So you have to always remember the priorities. You want to start with your goal, want to make sure you have an appropriate plan, make sure you have a good understanding of your risk level. Then you get into the investments and the taxes. So you have to keep that order in mind. But that was one idea. The second idea here has to do with whole life insurance.
Yeah, and the whole life insurance scenario is, you're putting the money away, you're getting it tax sheltered now outside the RSP, which is even better because you're taking it from one tax sheltered investment, basically putting it into another, and then that way it's going to continue to grow. It's got investments in there that are all sheltered. It's got an insurance scenario that goes along with it. But again, as you've mentioned, the sort of scenario is there's the pros and cons to it is the fact that once it's in there, well, you're not touching it. That's got to be gone for a long, long time for down the road. So theoretically speaking, this has got to be money that you can afford to put away. So if you were looking to take it out of the RRSP and put it into your non-registered and spend it down the road, well, that may not be an option. So again, that's something you have to consider, but it is another method to try and shelter everything that we have.
Yeah, and ideally, usually best suited for low-risk investors,
That's exactly it.
investors,
Yep.
because the rates of return on insurance can be okay, but likely not going to be better than, say, if you did your own stock investment.
right.
So this might be for someone who's more conservative in nature. We'll get in a more conservative strategy. It's minimizing the tax, but again, like you mentioned, not suitable for everyone.
No.
If you said, hey, I'm going to spend all the money in that account as part of my retirement plan, well, don't do this.
No, this won't work.
Because this is really more for the estate.
Exactly.
Passing money tax efficiently to the next generation, and then while you're alive, it minimizes your tax bill in addition to that. The third strategy here, so we talked about asset location, we talked about whole life insurance, still looking at that non-registered account, how to minimize the tax bill. The third option is corporate class investments.
Yep.
Now that's a bit of jargon there. A corporate class is a structure that was created to really pass down and convert the type of tax you pay on your investments. So instead of it being fully taxed today, it effectively becomes like a capital gain, which you pay down the road when you sell the investments. Now, capital gains tax is better in terms of the tax rate compared to, say, interest or to a dividend.
Yep.
It's more tax favorable. And that's what these corporate class investments do. Now, a couple of words of caution. The government has changed the rules around this in the past, so they perhaps could change them again in the future. And then also, not every strategy is available in a corporate class structure. Often you have to buy a mutual fund or an
That's the big
ETF
one.
that has this corporate class wrapper, and then you benefit from that tax strategy, but not all strategies will be applicable for that corporate class.
That's right. And it only
wrapper.
applies to certain areas that you want to deal with. You may want to try everything that way, but not everything makes itself into a corporate class.
Minimizing the tax hit on that non-registered account can be beneficial in many ways. We're using it in terms of the RRSP Meltdown. So
That's
there's
right.
less tax on that non-registered account. That keeps your income a little lower, which allow you to pull more out of the RRSP. Some folks just want less tax in general, even if they're not pulling more out of the RRSP, and they could use these strategies to minimize the tax on the non-registered account as well. Question here from Curtis. We'll put this up. The question is, he's withdrawing from his RRSP. He's
Yes,
doing
he
the
is.
RRSP Meltdown.
Yay!
His TFSA is all maxed out, so he can't put it there. So he puts
Nope.
it into the non-registered account. But that does create another tax burden. What do you do? And that's the problem
exactly.
that we're looking at, is that non-registered account.
It is. And most taxable income from your non-registered investments, I mean, so if you're getting taxed on that, it means you're going to take less from your RRIF or your RRSP, whatever the case may be.
It minimizes the effectiveness of your RRSP Meltdown strategy, because you got this extra tax
Exactly.
burden trying to deal with. So the solution, what we're going to look at,
Is asset location. And the
part
reason
of
for
it.
that is it depends on your tax situation. Now, your taxes are going to depend on what you've got it in. So anything that's in your RSP is going to have a certain tax, or your RRIF. Anything in your TFSA we know is not taxable. And in your non-registered, well, that's where things get tricky. So basically, if you got a RRIF, a LIF, PRIF, an RSP, anything you take out of that as tax is pure income.
all
That is
income.
pure income, as though you earned it yourself. If you're dealing with the non-registered, that's where it gets a little more tricky. If it's interest income like a GIC, that's taxed as though it's regular income. If you're getting dividends from a stock, such as a bank, that's going to be taxed differently. You're going to get capital gains if you've got a gain in them. Or there's the return of capital aspect, which basically is a delaying scenario for taxes not being paid now but being paid at a later date. That's sort of the area. And of course, the tax-free, we know, no tax at all.
it's completely tax-free. Yeah.
Yeah.
So this is the crux of the asset location strategy,
Exactly.
how it can
Where do we put
lower the tax bill in your non-registered account, and that could, of course, help with your RRIF withdrawals. And the idea that each investment could have a different type of tax, that's really
right.
what you're playing into here. Quick example, we just picked a marginal tax rate. We
That's
picked 43.4%. Really, if you're in a low tax bracket, this isn't an implication.
No, it's not gonna
only
harm
if you're in a higher bracket where this starts to make more sense. That's why you picked a larger number. But your interest income, say you have a GIC or bond, pays you
Yep.
interest, that's fully taxable, the full 43.4.
That's what you're paying
You have
on
a
it.
dividend, you do get a break. There's a dividend tax credit. So you can see that number is at 28.12%.
That's right.
Then you get your capital gains, a return of capital. They're taxed similarly. You don't pay the tax right away.
Nope.
You pay only when you sell. So if you don't sell, there's zero tax in that year. And you sell, say, 5 years from now, you only pay the tax 5 years from now. So you get that deferral. You do not get the deferral with the dividend
No.
or the interest. So
That's
one benefit,
every year.
deferral plus a lower number. Now we have a little wrinkle here. They changed the rules
Exactly,
a few months back.
in
So
June.
below 250 of capital gain, 21.7%. Above 250, a higher number, 28.9%.
Yep.
But this is the crux of that asset location strategy for that non-registered account. And we'll do a quick example here. You got your three
Yep.
buckets. Call it your RSP, RRIF, or any of that alphabet soup. your TFSA, and then that non-registered bucket.
Yeah, so if you see, I mean, right now we've got them all sort of aspect where you've got some income, you've got some return of capital, and capital gain, you got some dividend.
All of them.
Yeah, exactly there. But the way to do it differently is where am I going to put the best investments for that? So, I mean, if I want something that's earning pure interest, probably my TFSA, because it doesn't matter when I haul it out, I never have to pay tax on it. That's always a positive to deal with it that way. Same sort of thing can happen at the beginning in your RSP if you want. But again, if you're looking at that non-registered side, you want stuff that earns more of a capital gain, more of a return of capital, even stuff that's more of a dividend scenario because you're going to be paying less tax that way. And if you've got investments where you can get income that's less taxable, you can draw more out of your RRSP going forward.
That's the whole concept here.
Yep.
So Curtis's questions, hey, I'm trying to do that RRSP meltdown. I heard about it, saved me a lot of tax, but I have this non-registered account which is creating tax. So how do I minimize that burden so I can take more out of my RSP and RRSP and really draw that one down? Well, here's one solution, the asset location. You put the investments in the non-registered account that are going to have the lower tax burden, the return of capital, the capital gains, even some dividends. You got the lower tax burden there, which allows you to really chunk through that RRSP, chunk through that RSP, and minimize that, because that'd be the higher tax liability. That's the whole concept there. That's how Curtis can solve the problem that he brought to us. However, you have to have a few considerations.
There is.
Always trade-offs. There's nothing perfect, and one of those considerations is risk.
And that's a big factor to look at. I mean, remember, everything that we tie, the reason you're getting that tax break in the first place is because you're taking more risk in your investments. That's why the government's giving you these breaks. So if you're not really that risk-oriented, putting all this risk stuff in your non-registered may not be the smartest move. So you have to be comfortable with your risk trade-off to be able to get that sort of a tax break. And that's one of the big factors.
It is.
Yeah. So you've got a withdrawal from your non-registered account triggering. It makes the strategy less effective going forward. And of course, we're not just dealing with this. There's other factors that we have to look at.
Yeah, there's quite a few factors. A quick recap, because we want to make sure we get all the info here. Watching the risk, that you talked about.
That's the big one.
That's a key one. So not all investments have the same risk. So even if the capital gain strategy has a better tax incentive, you're probably taking more risk with that investment than, let's say, a GIC. So you have to keep that in mind. And then the withdrawals is key, and that ties it to our Becker Orr model of having a plan. If you're taking money out of this non-registered account, well, when you sell the investment and then you put it in your bank account and you spend it when you sell the investment, you'd be triggering the capital gains, which defeats the whole purpose of the strategy, because now you're triggering the tax as opposed to deferring it and using that time period to draw down your RSP or RRSP.
That's right.
So if you're withdrawing regularly from this non-registered account, different plan altogether. And that's why it really has to work within the structure of a larger plan. And the last piece here is the account sizes do matter.
They do. I mean, you have to have a big enough account size to be able to do it. If you've got a small TFSA or a small RSP, then you're really not doing anything where you can take that money out. It's not a big factor. And remember, taxes should not drive your investment strategy. They should help, but they shouldn't drive it. So the size of your account is going to have a big difference. If you've got a large portion in certain areas where you're taxed, that's something that you have to consider.
One final point here, you mentioned account sizes, that third consideration. Account size in terms of the size of the RSP and TFSA. So if it's a really small RRSP, well, you probably don't have to worry about this problem.
Not at all.
Also the size of the non-registered account. If you have a really big non-registered account, you say, hey, I'm going to move all of this to just capital gain strategy. Well, you've probably really increased the risk of your portfolio by having that much of a chunk in stocks or higher risk investments. Likely not a great idea. So keep the overall portfolio in check, so the size of the accounts matter there as well. We're coming back to this question here from Curtis, which he said he withdraws from his RRSP. He's doing that RRSP meltdown, trying to minimize it, but he has this non-registered account. His TFSA is maxed out, so he can't put the money there. He puts it in the non-registered account. That creates a tax burden.
It does.
It kind of restricts what he can do with the RRSP. What do I do? We talked about a few solutions in the past. Today we're talking about another solution for that non-registered account. Whole life insurance.
Yeah, whole life insurance is the next big one that we want to deal with. This is more of a low risk scenario as opposed to, say, an asset location or something which may have a little more risk to it. Basically, the low risk scenario, or the whole life scenario, is one where you're putting money away. It's going to be non-taxable. It's in a secure investment, and you don't have to worry about it for the length of time that's there. So, I mean, if we take a look at where we are, I mean, our asset pool is divided up one way. Again, if we're taking it, anything that's taxable, you want to keep in stuff that's sheltered. Anything that's non-taxable, you want to put in your or least taxable, you want to put in that non-registered pool. And that's where that whole life scenario would probably come in, is putting a whole life policy in there, depending on how much you want to put away.
Yeah, and again, the idea here is you're trying to draw down that RRSP. You're doing the RRSP meltdown, but you've got your TFSA full. You have the non-registered account, which creates tax every year because you got dividends and interest and capital gains.
Limit your amount.
So, all right, that's going to limit what you can do with the RRIF. So, for that non-registered account, maybe put a portion of those funds in the whole life policy.
Exactly.
Some of the perks there is that once it's in that participating whole life policy, it's not taxed annually. So you don't have that regular income you have to draw, which means the income from the non-registered account goes down, which means you can pull more out of your RRSP.
Exactly, which is not a bad play.
But some considerations, funds in the participating life insurance policy, a good news thing, it does grow tax-free.
Yep,
so it doesn't just sit there, you're going to get some growth. And it will be tax-free. A second consideration is that when you pass away, it goes to the beneficiaries tax-free. So there's lots of tax perks here. You got no bill in terms of annual income you had to claim. It grows tax-free, and then the overall pot, death benefit plus growth all goes to your beneficiaries tax-free. But lots of considerations in addition to that.
Yeah, and one of the big ones is, do I need my non-registered money? So if you said, I've got this non-registered pot, this is an excellent idea, let's put it all into the whole life insurance policy, that's great. But if I all of a sudden need to draw money from my non-registered account, you can't do that anymore. Once it's in there, it's done. So you have to make sure that the amount you're putting away is not going to affect your lifestyle in other ways, or if you need money from that non-registered portion. Because if you do need some, maybe a portion of this is worthwhile, but the whole thing may not be an option that you want to deal with.
Yeah, and technically it could get at the participating whole life insurance
if you want
really
to.
Had to, but then it messes up the whole strategy. It gets it far more complicated. It's really not ideal. You don't want to be setting this up with the thought that, you know what, I'll just take it out if I need it, because that is not how it works. That's not the way to get the most bang for your buck with this kind of strategy.
Yep.
So it's really more, how do you boost the estate in a tax-efficient manner, so you get in tax-efficient money to the next generation, and in the process, you're freeing up your year-to-year income, allowing you to draw down more from the RRIF. That's how it all kind of comes into play. Another consideration, it is insurance. You have to qualify. You have to qualify for life insurance. So if you're in your late 70s and your 80s, this might not be a great strategy. We have lots of clients in their 50s and 60s, however, that do implement this strategy.
That's
so it certainly is possible for those nearing retirement or even in retirement to implement. But it has to connect with that larger plan.
It really does. And that's the biggest factor. It has to be involved with your plan. Our mantra is always make sure you have that financial plan in place. If you have that, this strategy may be really appropriate for you and might be something you can look at. Again, because it is going to help. It is a low-risk sort of scenario. It will help with that RRSP meltdown immensely, because now you don't have that taxable income anymore. So these are a lot of varieties you have to consider. So make sure you have the plan to deal with it, and then consider what whole life insurance can do.
Yeah, and the question we got here from Curtis, again, withdrawing from the RRIF, doing that meltdown, but now you have this non-registered account that's creating some tax. Lots of ways to solve that problem. The one we're talking about today, the whole life insurance, would probably be a lower risk option of how to handle that particular tax burden. Continue to talk RRSP meltdown, ways to make it more efficient, to get more tax savings. This is all coming from a question we got from Curtis. He does that RRSP meltdown. He's withdrawing from his RRIF. He had been putting to the TFSA,
but it's maxed out.
So he's now going to put it into that non-registered account. Of course, there's tax on that average non-registered account. The tax of the income on that means he can only withdraw less from the RRIF. So you got this conundrum. What do you do? One of the solutions we're talking about here, Kevin, corporate class investments.
Yeah, corporate class investments. So these were created quite a while ago, and basically it was a way to try and avoid paying tax initially and sort of moving it down the road, which is what you really want to do if you're drawing out of your RRIF. So, I mean, the corporate class, it comes in an exchange-traded fund, it comes in a mutual fund structure, and it's structured around minimizing annual taxable distributions. So beforehand,
that's the idea.
Where you used to be getting all these distributions, now they're doing it so that, you know, the distributions are delayed or they're put into some format where we have to not pay the taxes now. Little or no, as I say, little or no annual distribution. Bulk of investment is reflected as a capital gain, and it is incurred only when those units are sold. So this is definitely going to help you out with your tax situation if you're buying into these things going forward.
Yeah, and we've got a nice graphic here. You can see how this could fit into that non-registered account. So you got your basic RRIF strategy, your TFSA strategy, then perhaps in the non-registered account, use some corporate class investments.
That's exactly
corporate class mutual fund, corporate class ETF, whatever fits your specific strategy. But the idea there is that now has less tax year to year. You're pushing the tax bill down the road. So you get some timing, you get some control. You know what, I'm going to incur that capital gain in maybe 10 years after I've already dealt with my RRSP and RRIF. And because of lower year-to-year distributions, lower year-to-year income to claim, I can take more and more out of the RRIF and speed up that RRSP meltdown. That's the whole concept right there.
And that's what we wanted from the beginning, where we wanted that meltdown sort of scenario so it goes. But again, it doesn't come without some sort of a scenario where you have to look at compensation. So one of them is your risk factor.
That's a big one.
you don't want to just invest because of the tax strategy. And not all strategies for ETFs and mutual funds allow a corporate class. That's one big factor that you have to do. The rules have changed over time. You used to have a variety of these things. You used to be able to switch from one fund to the other. The government's eliminated a lot of that. So again, this is a, for the time being, strategy we can use, but years down the road, maybe this won't be there anymore at either.
Yeah, and it's important to note, like, this corporate class structure exists because of certain government rules. It used to be in the past they had a lot more, specifically mutual funds. The mutual fund families would do this. Then the government changed the rules, and now you see a lot more ETF structured that way because of the rule change. And reiterating your point, not all strategies are available in a corporate class structure. So maybe you have a really good strategy like with bonds and dividends. Well, that might not be a fit for a corporate class. So perhaps the strategy you end up picking could be higher risk. You have to keep all of that in mind. So taxes should not be top of mind. Like we always say, when I have a goal, you want to have a plan, you got to monitor your risk, make sure your investments achieve all that, and then you can work on minimizing tax. And then point here, talking considerations, we mentioned risk, we mentioned the rule changes, we also have to mention fees. So you're getting lots of perks. These are products. They are created by companies, by fund companies, by ETF companies. They don't do that for free. They're going to charge your fee, and often the fee for the strategy within the corporate class structure could be a little higher than if you did that strategy outside the corporate class structure, because they're giving you all the tax perks. They're going to do this extra work to create the structure. They're going to charge a fee for that, so you have to keep that higher fee in mind. And then another consideration, the fourth one we're mentioning here, is always, with any of these strategies in the non-registered account, it's the withdrawals. And making sure that, when your withdrawals from the non-registered account, you are triggering taxes. The market strategy can then be a lot less. And as Clint mentioned before, with the fees similar to a seg fund, you've already wrapped something else in it. That's why it's higher. But the withdrawals, when you're taking them, is going to be the important factor. Because if you have to sell, you're automatically triggering some form of a tax that you have to deal with, whether that's a capital gain. The return of capital all of a sudden will lower things along those lines. So it is definitely something you have to consider when you're taking money out of it if you're going to sell these investments. And again, this is an important part to make sure that you know before you start drawing money out of it. That's why you always have to link it with the overall plan. Right? If the plan is, hey, I'm going to spend this account down, this non-registered account, in the next 10 years, well, don't do any of these strategies, because now you're going to do these withdrawals. As you do the withdrawals, you'll be triggering extra tax. That kind of defeats the purpose if you keep selling the investments. These strategies make the most sense if you're able to leave that account alone, and then you just kind of let it be. That way you're not incurring the tax when it's in the corporate class structure, and you can focus on drawing down the RRSP. That's the whole idea. If that's not part of your plan, no problem. There's lots of great ways you can minimize the tax with your strategy, but this is very specific for the scenario we described.
And this is one of many different things that we have to deal with in the RRSP Meltdown. If you want to find out more about this strategy or any of the other ones we've mentioned beforehand, please go to our website and go to chatwithclintonandkevin.com. Send the question in to us. We're more than happy to elaborate on any of these RRSP Meltdown things or any other financial transactions that you want to deal with or financial questions you have. By all means, it'll come to Clinton, myself. It's not robo-activated, so things along those lines. And we will get back to you in a timely manner so that your question is important to us and we can answer it from there.
And that's how we kind of got the kernel for this particular video. That's the question we got from Curtis. So please do reach out to us. Send us your questions. Send us your thoughts. We'd love to hear them. You like this video, we got lots of others like the one on the screen right now. Click on that one. We'll see you again very soon.
Take care.